All right, guys. So good morning to all and welcome to the second video for this forum. Just absolutely thrilled with the participation rates. We're already approaching about 500 members or so in the group, which is really exciting. And I'm giving some thought for this particular group to opening it up to more than just realtors, simply because there's a lot of people who have contributed in a meaningful way who are really investors. And really what we're talking about here are not intricate discussions as to how we perform our craft, but rather how we and investors themselves can find value in a product. And more importantly, when purchasing, find the mathematical basis for that purchase. That is very important. In fact, it's more important than just about anything else. And to that end, I think a group like this is really the most important thing that we collectively can do and learn from. So I see that there's quite a few people who are already on our screen. I expect we'll have a really good turnout by the end of the day. We already have a good turnout now. And without further ado, I'm going to turn my attention to our two administrative notes and then just get right into this. First administrative note is that this video, like all videos that we post, are public. If you ask a question, it will be public. If you say anything in the chats, that too is public. Anything on our forums are private to its membership only, but anything on these videos is not. Secondly, I would encourage all of you to take a look at what we're doing out on the forum, because I'm doing a series in writing right now called The Basics. And the basics are, if I'm to be very blunt, first year business finance or corporate finance, talking about how we move values of money back and forward through time and how we move income streams back and forward through time. The reason this is important is because fundamentally when you are working as a realtor, what you are doing is trying to measure what the present day value is of an asset. So the very math that a realtor needs is the math that I'm explaining through my posts on this forum to date. So far in the basics, we have not tackled income streams. We've only dealt with individual sums, but it is worthwhile going through that and figuring out what's going on. Anyways, to the matter at hand, I'm just going to load up, if you do not mind, my investment calculator, and we're going to get cracking. Bear with me, please, because right now it's decided it's not working. Okay, there we go. It's now working. And let me just share my screen. There we go. Can someone please confirm that they can see my screen? Feel free to unmute yourself or just, let me see, someone's chatted.
Yeah, there.
All right, everyone can see it. Okay. So again, I know some of you come to this with levels of sophistication that exceed others. And the whole purpose of this is really to make us all conversant in spreadsheets and financial math generally. So you'll permit me to start basic and then I'll kind of go into where we need to go. It is the case that this, that a spreadsheet is basically a large calculator. And any of you who are having trouble with spreadsheets can go back into my previous talk and you could see how we manipulate it and how we use it. It's probably best that you go into the first return on investment calculator that we did before. But basically, the way I set out my spreadsheets, the way I would encourage you to set out your spreadsheets is that all of the digestible information, all the information that you may care about is actually set out on this screen, this front screen. And in this case, you'll see that here's our assumptions that we're putting in, and then here's our analysis that the spreadsheet produces. It does so powered by these things at the bottom. You'll see it says deposit schedule, basic Canadian mortgage calculator, and the Canadian tax schedule. In other words, this particular screen is going to be pulling information from the next three screens, which are going to power and provide it with the information that is required as we go through our assumptions. And while it is somewhat similar to what it is that we have dealt with just last week. It is in fact different in kind because we're now dealing with a new build calculator. So before we go into the details of new builds, it's worthwhile talking about what this sheet will actually do for you at the end of the day. If someone comes up to you and says, is it a good idea for me to purchase new construction? There are several ways of answering it. First, you can say, yes, my Uncle Bob made a fortune. I made a fortune, and Uncle Bob's friend made a fortune. Therefore, you too can make a fortune. That is not a very good way of answering. That is anecdotal evidence, and it doesn't convince people who are more mathematically geared or minded to actually invest with you. Another way of doing it is saying, oh yes, absolutely, it's great. And then you blather on about the rate of growth of real estate. Real estate appreciates at 5 or 6% per year, yada, 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 yada. And while that is a bit more mathematically oriented and may even go into where it is that some of you speak to a client about, that isn't really an answer, because a growth rate of 5% doesn't tell you what the return on the money invested is. It doesn't give a detailed analysis. And after all, if you're dealing with investing clientele, many people want detailed analyses. And the detailed analyses that they want are somewhat contained in this particular spreadsheet. This particular spreadsheet is designed around showing you what your monthly costs and benefits are going to be and what your true returns are going to be. And so without further ado, let's turn our attention to that spreadsheet. So as before, as with last session, I'm going to deal first with the supporting documents here because we will make reference to them as we go through the main sheet. And the first supporting document that I'm going to be dealing with is the deposits. See, one of the features of new build construction is that you are providing the builder with a good deal of money for a good deal of time. And of course, providing the builder with a good deal of money for a good deal of time comes at a cost. It comes at the cost of not being able to use that money and generate profits on that money elsewhere. That just makes sense. If you give someone $100,000 for 5 years, you don't have $100,000 that you can invest in another piece of real estate. And as a result, in order for us to figure out what the true return is on an investment, we also have to accord for the lost value of time in the deposits that we are spending on the builder. And the deposit schedule is designed around that fact. And of course, because the deposits are actually things that the builder themselves dictate on every deal, filling it in is relatively easy. I don't need to go through the math that underlies how I did a net present value of deposits. It's somewhat complex. Sufficient to say that I will be addressing net present value as a separate write-up in the coming weeks on this site. What you need to understand is that I am going through this page to take the total value of deposits that are going to be paid on a given deal. I'm going to assess when they are paid on a given deal. And each payment I am going to bring back into a present day sum. Why am I going to do that? I'm going to do that because the essence of financial math is that you cannot compare $100 today with $100 in 5 years. They're not, even though it's the same figure, they're not worth the same. You'd prefer to have $100 today because you can throw that in a bank account and earn interest on it such that it's more than $100 in 5 years, if that makes sense. And as a result, if we're paying money over time to the builder, we need to figure out what the true money paid to the builder is. Because though we might be paying, say, let's say that we have a date from signing. So we're going to have, I'm going to just put in a quick date for signing. Do we have a date for signing here? Let me see. Date agreement is signed. So let's just put in a day of January 30th, 2020. That's when the agreement was signed. Okay. So we go back here and we see that 0 days from signing is January 30th. We usually have a deposit schedule. Tull, can you unmute and help me out? What's a normal deposit schedule for deposit 2, 3, 4, and 5 on a new build?
Hey, Mark, say 5% in 30 days.
Okay, so deposit 2 is in 30 days. That's fine. Next,
And then you go.
what's deposit 3? How many days? 60?
So the deposit one's 5,000, and then 5% 30, and then 5% say in
Don't
180.
worry about how much is down. Don't worry about how much is down. Just tell me the days that you usually contribute.
So 30, 180, 365, and then occupancy. Say.
All right, I'm going to say 365, 600. Let's just say, and then last deposit on occupancy. Fine.
Now they've actually extended them a lot more than what we're used to.
Okay.
Because of COVID. But.
Well, let's just use this for a second. You can see that by putting the days down, it has automatically changed when these dates are paid, right? Although for some reason, the reason is last day on occupancy. We have to put in date of occupancy. So our date of occupancy on a January 30th, let's say that this is a 4-year purchase, okay? January 30th, 2024 is when this is going to be done. So that will fill this in. And so that's 1,461 days from signing. The amount due in day zero is 5,000 on deposit. The amount 30, you can figure out what the actual inputs are, but I'm just going to make stuff up. 25,000, 25,000, 25,000, let's say 27,500, let's say 23,400, let's say 30,000, and let's say 40,000. I just made up figures that are due. So what we now have is we have the amounts, the days from signing, and the days paid. Now I'm just curious, hold on one second. I probably should have figured out rates, values, and dates. Give me 1 second, please. That's the problem. Okay. So that is where we are. I'm going to get to these in a second, these final 3 things, because it requires me to fill out some stuff on the first page. And what we're going to do by having this income stream here and having the days payable is we're going to take each of these figures back to the present day and say paying $5,000 on day 0, $25,000 on day 30, $23,400 on day 180, and so on, means that I am paying the global sum of X on day 1. And there's a way to do that, and I'll show you how to do that shortly. But the reason that we want to do that is because if we have that down, then we understand what our true investment is over the course of several years. If that doesn't make sense, I'll go over it as we go. I'm just trying to explain the pages that are going to power our sheet. We then have our basic Canadian mortgage calculator. This is effectively designed around, similar to last week, figuring out how much for a mortgage every monthly payment is, and more importantly, what percentage of a monthly payment is devoted to interest and what is devoted to principal. Why does this matter? This matters because when you are paying your monthly mortgage payment, any amount that you are paying in principal of your total monthly payment is in fact being paid back to you. It's coming from one account and going to the other. So that's not a true expenditure. It's a cash flow expenditure because you don't see that money, but it's not a true expenditure. So we need to break it down. Again, we'll talk about that as we go forward. And last, if we're to truly analyze a new build investment opportunity, we often have to get back to smaller investors who then say, what is this going to cost me after tax? And to figure that out, we need to actually multiply whatever our amounts are by tax at the end of the day. So this is a bit confusing at the present time for most people who are listening. And that's because we haven't really started going through our spreadsheet. Let's start bringing this to a head and making it clearer. This spreadsheet will be available for download. I will post it as part of the video feed once we are done. So we are going to take a standard new build agreement where you are paying $540,000. Let's just call it that. On $540,000, you are going to also have to pay, of course, land transfer tax. and I'm just going to pull, I'm just going to make up the land transfer tax payable on this. Okay. Permit me. I know that this is wrong. I'm not looking it up right now. I'm just going to call it, say $10,000 hypothetically. Okay. Doesn't matter for the purpose of our analysis. You're going to put in the right land transfer tax. And we're going to have closing costs. And the closing costs, you'll note, I'm not sitting here trying to analyze what the true adjustment costs are or anything else. That's the job of your lawyer and is done on a per deal basis. I'm going to assume that in addition to land transfer tax on a $540,000 unit, we are going to be paying another $15,000 in development charges, in Section 37 levies, in legal fees, and God knows what. If you do not know what that means, do not worry. First of all, you can go back to the legal forum and you can see that we've talked about that a good deal in some of our new build lectures, but also I'll be talking about that as part of this forum in the coming months as well. Suffice it to say, on every new build agreement, in addition to your land transfer tax, there are a range of fees that need to be paid as part and parcel of every deal. And those fees are what I've termed the $15,000. The next question is really critical. The next question is, how long are you expected to own the property in years? Note, I'm not saying how long you're expected to own the contract. I'm saying, how long are you expected to own the property once it closes? And for this case, I'm going to say, we're going to expect to own it for 4 years. Why not? Okay, so basically I'm going to have a contract. I'm going to hold on to my contract for 3 years. I'm then going to own it for 4 years. I'm going to sell. So 7 years after I sell my contract, I sign my contract, I'm going to sell it. That's when I'm going to receive my money for this. The date of my expected ownership. So as you're aware, possession is different than ownership in new build. Possession is the interim occupancy. Ownership is usually about 3 months after the interim occupancy. If you do not know what these terms mean, again, I'm happy to go through them, but I'm assuming that if you are part of this, you are familiar with the new build world and these terms make sense to you. So I'm going to just call it March 30th, 2024 is going to be our date of expected ownership. Our years until purchase are going to be 4.17, which makes sense, right? We're signing our agreement on January 30th, 2020, and we are taking ownership on March 30th, 2024, 4.17 years. You'll note that this filled in automatically. That's the beauty of spreadsheets like this. Spreadsheets like this, you'll see the blue means that you are inputting stuff. The yellow or the green means that you don't need to touch it. It will fill out automatically as you go through this process. And that's a really critical thing to understand. Your condo fees. We can estimate that the condo fees for the first couple of years will be $350. Note there's a lot of estimation here, but if you are a new build agent who regularly deals with these things should somewhat be back of hand. These things are known to you. You may know 65 cents a square foot as a calculation, and you'll be able to figure it out. I'm leaving these things blank because the goal is not to fill you in with every bit of information, but rather to allow you to take the information that surrounds the real estate world and plug it into an appropriate spreadsheet that gives you a response. Miscellaneous, let's say that it's $50 a month because you're in a condo and it's condo fees, and your monthly rents that you can get from this place are, say, $2,000 a month. I'm going to pause for a second. I work with Tull a lot on new builds, and I know that he's a new build expert. Tull, do all my assumptions look somewhat reasonable so far for a condo in, say, Mississauga?
Yeah, I mean, so far it's pretty reasonable. Maybe maybe land transfer tax you could put to, say, 15,000, 20,000 from 10,000.
Yeah, okay, fine.
Unless you're a first-time buyer.
Doesn't matter. So that's fine.
Yeah, it looks good.
Okay. Sorry, I see there's one small issue. I like to have accuracy. There we go.
But
okay.
The monthly rent's now went down, so maybe put it at 1,800.
All right. Well, that's fine. I'll put it at 1,850. Okay. Now, your LTV. So your loan to value. I'm going to assume that your loan to value on this is 80%. That is to say, a bank is going to lend you 80% of the purchase price amount. $540,000. I apologize, guys. I think that we have, there we go. Okay. Your mortgage rate. Well, that's a critical component, right? Because it's going to determine how much in interest you're paying versus principal, of course. So mortgage rates are ridiculously low, but for the purposes of just this spreadsheet, I'm going to say not 235%, 2.35%. And your amortization period, I'm going to say is a 25-year AM, and your term is going to be 5 years. Again, if you aren't familiar with what these things mean, then we can go into this in detail in subsequent discussions. I am assuming that every single person should understand what an amortization period is and what a term is, because this is what we regularly deal with. But if you do not, the purpose of these sessions is learning. You are more than welcome to contact me, and I am going to be hosting a whole range of mortgage sessions. We have a really interesting one actually coming up where I'm going to get a whole bunch of mortgage people together to talk about the future of the industry and where we're going and everything else. Okay, so far so good. Everything should have been very clear. The next thing you really need to understand, and this is going to be the one thing that is difficult to understand, is the discount rate. The discount rate is, if I'm to put it bluntly, how much you discount money year over year. And it's personal, but for real estate, we can say it's 5%. And when I say how much do you discount money year over year, what I mean is this. All right, hey, Joe, I can give you $100 now, or I can give you $105 next year. In other words, I'm discounting the value of money by 5% every year. We can figure out, using that discount rate, what it is I would need to give you in year 10, in year 20, in year 30. And that's an easy way of allowing us to say, all right, 105 in year 2 is 100 in year 1. It's kind of like an interest rate, but it's different because it's not predicated upon the Central Reserve or anything else. It's just how much you are discounting your money by every single year, which will allow us, you'll recall on this deposit schedule, we have different timing. We have to bring it back. We have to bring it back to year 0. And in fact, that's exactly what we are doing. I can now show you the deposit schedule because we've put in the discount rate of 5%. So take a look. If I were to just take the sum of these amounts, I would find that actually the sum of those amounts is $150,000. But you'll see that because we are discounting, because this $40,000 is not $40,000, but is worth less, we've discounted it because we need to calculate it on year 0 by 5%, which was our discount rate. The present value of this added up is not 150, but rather 140. Did that make sense? I need people to tell me that that made sense because that's a critical component. Andrea gets it. That's fantastic. Does anybody else have a problem with that? Jack gets it. Okay, everyone says it makes sense. That's great. And because we now have that present value, because we now know what we are paying in day 1, even though we're paying it in day 600, even though we're paying it on January 30th, 2024, because we know how much it is in day 1, we can start saying, all right, it's as if it is paid in day 1. And because that's paid in day 1, we can now figure out what the annual cost of borrowing on that amount is, which happens to be $6,976. Why? Because we are taking C23, which is our discount rate. We're saying, all right, we're saying that the discount rate in this case is the interest rate. I don't know why I did that. Usually I don't do it by that. I usually say, sorry, I'm going to make a change here. Interest rate on interest rate on money invested normally, just to make it clear. And I'm going to say that I can make 3% on that. So I'm going to take this and I'm going to make that times 24. Sorry. So what we've done is we've taken this amount and I've multiplied that because I know that that's how much I'm paying yearly. And I know that if I took that money and if I invested that money, I could get 3% on that money. And thus, my 3% would net me $4,185. In other words, by putting this money down in present day at $139,000, I am losing $4,185 in investment per year that this is taking place. And as a result, the cost of borrowing for taking all of this out, the cost of borrowing for the deposits, there's another way of looking at this. Sorry, I should. Interest rate on money invested, if borrowed, if cash paid for deposits, or I'm going to write this out, or interest on money borrowed to afford deposits. I know that's very long, but that will really explain what's going on. Hold on a second. Format. I'm going to align. Where is it? I'm going to wrap, go. Okay. So what this is this is the interest rate on money if cash is paid for the deposits, or interest on money borrowed to afford the deposits. Hopefully that makes sense. I'm sorry. I know that's a bit much, but it's important. And the reason is because on your deposit schedule, what you're doing is you're saying, okay, I'm either borrowing this money or it's coming from just cash that I have lying around. If it's coming from cash that I'm lying around, I'm losing money because I'm giving it to someone else and I'm not making money on it, and I can make 3%. Or if you're borrowing it from your line of credit, okay, I'm borrowing it and I have to pay someone else 3%. But either way, I am losing $4,185.77. And thus, the cost of borrowing becomes this multiplied by however many years it's going to take me to get to closing, right? Because I'm going to lose that every single year, year over year over year over year, on a compounded basis, by the way. This calculation is compounded, meaning that if I take 4,185 and I have 5 years to get there, then I earn 3% is the detriment per year, but that detriment is compounded to get to the 5th year. Regardless, what it means in effect is that because I am making these payments, I have to pay $31,457 per year in order to hold on and make the payments and get into the game, which will allow me to close. And that needs to be calculated as we go through this analysis, and we'll go through that very shortly. And Andrea asks, so we can call this either our op costs, or if it's cash, or our cost of borrowing. Exactly, that's exactly what it is. And I wrote it a bit more bluntly, Andrea, just so that people don't get confused, because it's a bit hard to understand. Then you have your real estate, but why 5% on the discount rate and why 3% on interest? Because discount rate and interest are not the same. Discount rate are what you can do. It's based on an internal, this is too complex, but it's based, just to answer you, everyone else can ignore this answer. The difference between a discount rate and the interest rate on money is that an interest rate is set by the Federal Reserve. A discount rate is set by your internal rate of return, which, if you're a private investor, is often much higher than 2% or 1.65% or whatever it may be. And thus your capital is actually going to be determined. If you turn to someone and say, your discount rate is going to be 3%, they're going to be, screw you, I get 8% on my money. And so you have to actually account for their needs. Okay. Ignore that if that doesn't make sense to people. Let's talk about the real estate appreciation rate. So the real estate appreciation rate, I've talked about this last session. Since World War II, real estate has gone up by about 5% per year. I know I'm looking at a whole bunch of people who don't have lines or creases on their face, and they all believe that real estate goes up by 10% per year. Although, in fairness, these past couple of months, everyone's been kind of experiencing some of the reverse. So let's just assume that we have a healthy 6% year over year growth rate, okay? That's what we're going to assume. And we'll explain why that's important in a minute. And we're going to talk about the marginal rate of tax. So I'm going to go back to our Canadian tax schedule. I've dealt with this before, and I've given whole lectures on tax before, but I just want to make sure that everyone here is clear. In Canada, we have a marginal tax rate. And what that means is that everyone earns on the first four, it doesn't matter if you're a billionaire or someone who just makes 20,000 bucks, every person on their first 44,740 pays 20% tax on that money. Then between 44 and 48, they make 24% on that money, and so on and so forth. And it goes up until you make $220,000. So if you're at a job that pays $220,000 as a salary to you, and you make a single dollar above that amount, you will be paying tax at 54%. And this is my political part of the lecture. Many people are absolutely sickened by that amount. I am sickened by that amount too. But do keep in mind that simply looking at that top tax bracket and saying, I am so sick of Canada and its taxes, is missing a much larger picture, which is that the vast majority of us don't make $220,000. And so the governments can and readily do adjust these taxes and give much more room for average people by raising these rates and keeping this one ever higher. So when the Ontario government of 15 years ago or 10 years ago was at about 43%, now it's at 53%, the government itself didn't raise much new revenue by changing that tax rate, even though it started taxing the wealthy people a lot. And the reason is because it lost it here. They changed these rates. They changed these rates upwards so that everyone benefited by paying less tax. And it was only if you were the very wealthy. P.S. You guys are largely the very wealthy if you're listening to this and you're in real estate, that actually now needs to pay more. Just consider that. Regardless, the idea, the conception here, this isn't a political lecture. The conception here is that you are paying 54 cents of every dollar you earn above $220,000 to the government. As a result, and we need to know that. So what's my marginal rate of tax? Well, I'm going to assume in this case that the marginal rate of tax is the 54%. And I'm going to assume that the capital gains rate of tax is the 26%. So I am assuming that the people who are using this calculator are making more than $220,000 a year. If they are not, you can pick a different level. But for now, I'm going to assume that. Oh, and then we have a cost of borrowing. How interesting. I'm sorry. So that I'm going to, I don't need a cost of, I'm going to make the cost of borrowing, if you don't mind. I'm just going to put that in here just to keep this consistent. And I'm going to change this to yellow because I don't want you guys touching it. I'm sorry. I screwed with my spreadsheet and I shouldn't have screwed with the spreadsheet. And this teaches you a valuable lesson about screwing with the spreadsheet. It's just going to pull directly from this line, which I created. And then you have your realtor fees. So what are your realtor fees? I'm going to assume 5%. Do not tell anyone, by the way, that you're going to give them a deal of 4% or whatever it is. Be conservative with your investors. Always be conservative with your investors. And last, we have the mill rate. Now, those of you who attended last week's lecture will know what the mill rate is, but very plainly, the mill rate is how taxes are actually calculated. Every city in the province has its own mill rate schedule. And figuring it out is very easy indeed. And we are going to figure it out right now together. Sorry, 1 second, please. I don't know why my screen just decided to do that. Fantastic. Let me see how I get this back. Sorry, guys, Zoom issues. You're just going to have to bear with me. So I'm going to do a new share. I'm going to go to my desktop. And I'm going to show, oh, that's not right. You don't want the desktop. You want the Firefox. There we go. And you'll see that if I type Toronto mill rate, which is what I'm going to do, and go here, property taxes and fees, you will see that there is a property tax rate section. It's this easy for Mississauga or anything else. And you will see that there is the number of the Toronto mill rate. So let's put that in. Oops, that didn't work at all. How embarrassing for all of us. Let me see if I can get that back. Excuse me for 1 second, guys. That was a failure. As the kids say, that was a fail. Oh, that failed again. Let's try one last time. I'm just going to write it in. So it's 0.599704. So 0.599704. And it is 0.0059 because it's of a percent. Let's make sure that we are accurate by putting in a couple more decimal spaces. Okay, there we go. We have the mill rate. So what is that mill rate? You saw me just take it from the website. Oh, sorry, no one is seeing my screen. I apologize. So I'm going to share my Excel again. I apologize. So I've put it in here. And what is that mill rate? That mill rate is the tax rate that the City of Toronto is going to actually multiply by the MPAC assessment rate. Every 4 years, MPAC, the Municipal Property Assessment Corporation of Ontario, comes around and gives a value to every PIN in Ontario. Once that PIN has been provided with a value, that value is then multiplied by the mill rate of the jurisdiction in which it's in, and that's how your municipal taxes are determined. So rather than have to guess what your municipal taxes are, rather than guess, you are able to now calculate what the taxes will be on a purchase price of $540. Because after all, if I take $540, if I take, just as an example, $540, and I multiply it by the mill rate, I get $3,238 per year, which is what the taxes will be. Now, they won't be there at first. You're going to be assessed after year 2 or whatever it is, but it will even out and it will be roughly that amount. Okay, so we've now filled out this spreadsheet. Let us now turn our attention to what has now happened. So the first thing that happened is you'll note that even though our purchase price was $540, the purchase cost was significantly more. Because the purchase cost, the cost at the time that we go ahead and buy this unit is not going to be $540. It's going to be $540 plus the land transfer tax, plus the closing cost, which would bring us to $570, right? But remember, there is also the cost of the deposits that you've put down, which we took back into present day value, which we determined had an annualized cost, and which we now know as of the day of closing will have cost us $31,000 in lost rev. And we have to add that too. And as a result, the true cost of purchasing my $540,000 condo in year 0 on something that is closing in 4.17 years is actually $600,000, not $540,000. I'm going to pause. Does everyone understand how I got that number? Everyone get it? Harpreet gets it. That makes me happy. Does anybody not get it? Maybe that's the way to ask it. Stuart gets it. An unknown person gets it. That makes me happier than anything. Susan gets it. All right, everyone gets it. Fantastic. So we have our purchase cost. We also know what the bank is going to provide. How do we know? Well, we know that they're going to be providing 80% of the $540,000. The bank is going to be providing $432,000. And thus, the total amount of money that you are going to need to invest on day 1 is the true purchase cost. And then from that, you subtract what the bank provides. And that brings you to $170,000. That's how much money you're going to have to invest in order to get into this condo at $540, right? And so what happens? Well, now an investor says, okay, I now know how much money I need to put in. I now understand what this costs. Thank you for that clarity. They're going to ask you the next follow-up question. Well, is it worth it? And the answer to figure out if it's worth it comes in 2 separate sections. And the first thing you need to prepare them for is that it's not going to appear to be worth it. Because if we take a look at the monthly cash flow, which is how most people determine their investments for reasons that I cannot understand, but probably explains why most of us spend our lives in financial destitution, you will see that the cash flow statement is negative. You will see that if we take our monthly mortgage amount, which now, by the way, is coming directly from our mortgage calculator, right? We have $540, we have an interest rate of 2.35, all the terms You can see what the monthly payment is. I'm going to, by the way, give a session on how to build a mortgage calculator in Excel in this forum later on, but that's not presently what we're doing. So we have a mortgage payment of $2,378. We have an interest payment of of that amount. Interest is $1,052, and your principal payment is $1,326. Okay. Of that amount, true interest, the money going away, the money that you might as well set on fire, is $1,052. Oops. Oh, did no one see that? Oh, no, you all saw that, of course. Yeah, I was on the right page. Sorry. So let's go back to our calculator. So we have, everyone is still seeing my Excel sheet, right? Can someone just confirm that they're still seeing my Excel sheet? Yes, okay. So we have our monthly payment of $2,378, plus we have our condo fees of $350. Note, it's just dragging it from here. We have our miscellaneous payments of, oh, that's weird. So let's take that. There we go. We have our miscellaneous payments of $50 a month, and we have our tax payments of $269 a month. TEL has generously reduced our rents to $1,850. Thank you, buddy. And as a result, if we add up our monthly expenses, we are going to find out that every single month we lose $1,200 on this investment. Yowza. You know what? I'm going to change the interest rate a little just to make this a bit more appealing, because I'm going to make it into the 1.99 territory. You can easily beat that, but I just, you know what? I'm going to even make it 1.85. I'm going to use real interest rates. All right. So you are at $1,000. You can put rents up to 2,000 and assure we're not in Toronto. Okay. I'm going to put the rents up to 2,000 just because TEL has given me allowance, but also because, remember, the rents we're talking about are not rents today. They're rents at the time in 4.17 years, right? Remember that. So this is all talking about, this whole thing is this monthly cost benefit analysis, is a monthly cost benefit analysis once you take possession of the condo, not at the very beginning. And so 2,000 is probably something pretty good, because we're going to assume that rents have gone up over the course of 4 years. TEL allowance? All right, so Jack is saying so rents should be 2,800. Let's not push it. Let's just keep it at 2,000 right now. You can put in whatever allowance you want. And the unknown person, the mysterious unknown person asks, is the loss starting from 2024? It is starting from 24. Yes, I just answered that. Okay, so that's fine. So every single month, we're now losing $917. What, however, are the true monthly costs and benefits? Because the true monthly costs and benefits are not that you're losing $917, is it? Absolutely not. You will recall that in your Canadian mortgage calculator, you are paying $2,247, right? $2,247. But a portion of this is going to interest, and a portion of it is going to principal. And that principal is critical because it is your principal. It is a bank account that you own. You can't access it, but you own it. You're paying yourself. And as a result, the true cost of this is not losing $917, because critically, there has to be the principal repayment line of $1,418, which is how much you are paying yourself every month. Also, if we're to be fair, we know that you have invested $169,000 in this project. And that cost of invested money needs to be accounted for as well. Because you cannot have $170,000 down given to someone, in this case, the bank or the builder or whatever it is, and not say, hey, that costs me every single year in lost interest. The cost of borrowing being 3%. Or the interest rate here. And as a result, to do a true cost analysis, you need to take all of the above, and you have to add back your principal repayment and subtract the amount of money that you are losing in interest on the balance that you originally paid, giving you a true benefit of $77.18 per month. Does that make sense? Does everyone get that? That's complex, but there it is. Susan says, why? Harpreet says, yes. I'm assuming then that we now understand that a cash flow basis, this investment looks terrible. But on a true monthly basis, Stuart says, kind of. Okay, Stuart, keep on working with this because it's tough. Like a lot of people who are saying yes to this are familiar with this math. It's building on their knowledge base. And for a lot of people who are coming at this, they're coming at this very new. And they're going to have to listen to this video again, and they're going to have to fiddle with the spreadsheet on their own to figure out how this all plays out. But it will become clear. I promise you, if you just pay attention and give it its time. The be all and end all is that this here is going to be what the investor sees in their bank account, and they're going to feel sick to their stomach every month saying, I got to get out. This is going to be your value add where you say, hold on there, don't worry, you are still making money even though you're losing. It's like contributing to an RRSP every month. If you do that, it's going to look like you have a negative, but you're still paying yourself. And so you are doing that here on this mortgage where you're making $77.18. Your investor will then turn to you and go, well, what the hell? You're telling me that I'm going to go through all this for $77.18? And that's where the next part of your analysis comes in. Because the next part of your analysis is to say, hey, it's not the $77.18 that you're looking for. That's not it at all. It's on the capital appreciation of the property where you really excel. So not only will you make $77 sweet dollars and be able to go to Applebee's and order a dessert every single month, but you will also be able to make a fortune when you sell. Let me show you how. And to do that, you now need to turn to the capital analysis of the spreadsheet that we've built out. And the capital analysis is very simple. First, you have to figure out the sale price. And the sale price is actually something that we can determine because what we've done is we've taken the purchase price and we've added however many years. How many years? 4.17 plus the years of ownership. Excuse me. Plus the years of ownership of 4. So we're looking at 8.17 years. We take the 540 and we multiply it compounded by the real estate appreciation rate over 8 years. And if we do that, we find that the property that you paid $440,000 for is now worth $870,000. This is actually the critical reason why we invest in real estate. And permit me, I've talked about this last time as well, but I'm going to talk about it now. You are able to borrow at government rates on property. You cannot borrow on government rates for any other investment in this world. If you go in and say, hey, bank, I'm thinking of starting up a restaurant, the first thing they'll do is they'll say, please bend over and let me kick you as hard as I can. If you can get someone who will loan to you, they'll loan to you at 12%, 14%, the like. Whereas if you invest in real estate, you're able to get government-based rates, which means that you pay very little interest rate while appreciation continues to go up at a rate that is approaching 6% on the whole amount, not just your $169,457. It's going up on the whole kit and caboodle of $540,000, meaning that by the time 8 years and 17th of a year have passed, your value of your property is now $870,000. And as a result, your gross profit is, in fact, this minus your purchase cost, not your purchase price, your purchase cost. So that's your gross profit. Then, of course, you have to pay your realtor fee on this. And remember, it's 5% plus HST. You all know that. Then we have to factor in what the accrued benefit or detriment of ownership is. Because for 4 years, we have made $77 a month. For 4.17 years, for 4 years, we've made $77 a month. And that needs to be accounted for. And that is here. And this is not such a big deal, but it is a big deal if you're making, say, $500 a month here. That could be a significant sum. We need to account for that to figure out what the analysis is, how much money we're going to make in total. Or if this is negative, let's just change this for a second to 2.99. If this is negative, you'll see we have to accrue for the $20,000 detriment, right? If this is 0.99, we're probably going to get there. Oh, 99%. Whoops, that's not right. You'll see that there is a significant 22,000 the other way. So the interest rate obviously does matter, but that's not what I'm trying to show you here. What I'm trying to show you is that we need to account for really screwing up this interest rate, 0.00185. There you go. Hold on. Sorry, guys. There we go. So we take the sale price, right? From there, we're able to figure out the gross profit. We're able to figure out the realtor fees. We're able to figure out the accrued benefit and detriment. And on the basis of that, we can take our gross profit, we can subtract our realtor fees, we can add or subtract our accrued benefit, and we can figure out what our net profit before tax is. Our net profit before tax is $222,000. That's how much money we have made on this investment to date. Hold on a second. The cost of invested money line. This continues to account for the opportunity cost. You know what, Andrea, I'm going to address that afterwards if you don't mind. I just need to get through this one. Your questions are always very good. So at $220,000, we put down $169,000. We are getting back $220,000. And if we did that in year one, we were making 131% on our money. That's pretty darn good. But remember, we're not getting $220,000 the very next year. In fact, we are getting $220,000 4 years later. Because remember, this $169,000 is what the investment costs at the time of purchase, not at the time the contract is signed. So 4 years later, we are making 32% per year. It's just, I could have done it on a compounded basis. I didn't. I just did straight line. What's the investment per year that I'm making to get me to 130? It's roughly equal. And so we have a 32% return on investment in this condo. And for those of you who care for tax, if we're going to be income taxed on this, which is a higher rate of tax, then our rate of investment is going to be 15%. How do I get that? Well, I basically take my net profit and then I multiply it by the income tax, the marginal rate of tax on income. And then marginal rate of tax on capital gain. Sorry, I'm just making it clearer. So this one here is simply taking the 220, multiplying it by the marginal rate on income, and that's giving me how much I have at the end of the day. And so what's happened is I've invested 169,000, and after 4 years, I'm getting back 103,000, which gives me a return on investment, post-tax return on investment of 60% over 4 years, or 15% per year. And on a capital gains basis, which is double that, of course, you are making 162, meaning I have a post-tax return on investment of 96% over 4 years, or an annual return on investment of 24%. And it is these functions, this here, actually, it's this here that most sophisticated investors will care about. You are going to be able to say to them, hey, 32% on your money. That's what this investment shows. Yes, you are going to make $77 a month. That's true. That's peanuts. But where you're going to excel is that this will make you 32% on your money. How can you say no? And if they're less sophisticated and they say, yeah, but I have to pay tax on that money, which is a stupid thing to say because investors shouldn't be saying that, but many do. You could say, okay, let's assume the worst case scenario and you're taxed at an income tax rate, not a capital gain rate. You're still making 15% on your money. And here's how. Show me where I'm wrong on these assumptions. And after you go through this with them, they'll say, yeah, well, but my uncle has an investment in Bitcoin or something. And, they're telling me I can make 10% per year. You could say, screw that. Bitcoin is ridiculous. Real estate is secured. And I'm making you a return of 15%. Invest in me. Stuart asks, am I borrowing the $149,000 on a line of credit, $167,000 on a line of credit? So the answer is that is accounted for in the cost of borrowing here. And it doesn't matter to me where it's coming from, but we are accounting for it as a borrowing feature. So if you're using your line of credit, if you're using your own cash, doesn't matter. There's still a cost to putting this down. And it is usually done through a line of credit, but who knows? What matters is the math here, and it's being done through the cost of borrowing lines. Does that make sense, Stuart? Real cash or line of credit, you still have to pay an amount. If you use real cash, you're losing money that you would have ordinarily earned in interest. If you're borrowing from a line of credit, you're paying the bank for money that they're losing, but it's the same general concept. So guys, it's 11 o'clock. That was 1 hour. I know that this was somewhat challenging, and I know that math is somewhat challenging. I will commit to people here that those people who are struggling with this, I'm just going to ask that you stick with us. Financial math is something that you do not get by virtue of a simple meeting like this for 1 hour. Financial math is something that you have to learn as you struggle with over time. It can take upwards of a year, really kind of struggling with ideas and concepts and having them explained and really kind of figuring this out. I would strongly suggest that you guys rewatch this video, fiddle with the spreadsheet when I've posted it, and continue to be part of our sessions as we kind of go through the basics of financial math, which will help you become the professional you want to be for your clients. That is what I would say about this. I thank you very much. Our next tutorial is going to be on commercial spreadsheets. Strangely, they're not actually more sophisticated. It's actually quite easy to do, but I'll be doing commercial investments and commercial properties probably pretty soon as the next one in this series. I'm not sure if that's going to be the next video we do, but it's going to be the next one in this series. I wish you all the very best. I thank you very much, and I'm going to turn open to questions for 2 minutes before we finish. Any other questions, guys? Feel free to unmute yourself and ask.
You know, I have like 20 questions, right?
I do, Andrea, yes. And you have to keep in mind, Andrea, we need to keep it a bit simple for people just because this is really overwhelming for a lot of people. So I'm just hesitant. I did owe you a call. You and I were scheduled to speak, so I can speak with you right after this if you like, and we can go over some questions. It's just I find your questions are more sophisticated and based on having used these numbers before, and I'm very concerned with people who are approaching this for the first time.
Gotcha.
So, Mark, same question as before this started. Would the spreadsheet adjust if we would change the amortization from 25 to 30 years?
Yeah, let's see.
The
I thought that I had done that. If not, then I had set it up incorrectly. Well, let's try. So right now, our Canadian mortgage calculator has payments of 2247, right? And I have 25 years. Let's try putting in 30 years. Yeah, 1953. There you go. Yes, it does change. Okay, Jack? Jack, are you there? Well, Jack is gone, but Jack, to answer your question, yes, it is adjusting and the spreadsheet is working properly.
Sorry, I was muted. Does it adjust the number on the true cost?
Yes, of course it does. Here, I'll go back. So because it's adjusting the monthly payments, it is adjusting the principal payments, right? The principal payments is going down as well. See that?
Yeah, but on the main sheet.
The main sheet is pulling from that principal payment. So if you take a look here, this principal repayment is now reflecting the 30-year amortization because that amount is now basically on this. If I change this to 20, if I change this back to 25, you'll see that this principal repayment went from 12 to 14.18. Here, watch, 30, it went to 1124. 25, it went to 1418. Does that make sense?
Perfect.
Okay. Okay, guys, that's, I think that is pretty much it. How do I calculate resale value? Mary, resale value is very simple. All you need to do is figure out what the appreciation rate is in your area. All I'm doing is I'm saying, if we purchase it at this in year X, then year 8 or however many years means that the property value has gone up by 6% per year or 5% per year or whatever it is the real estate appreciation rate is year over year. That's how I calculated the resale value. Does that make sense, Mary? I'm going to assume yes. Okay. Remind me of what the accrued benefit means. Andrea, the accrued benefit, I'll again share my screen just because otherwise no one's going to understand what the devil it is I'm talking about. So the accrued benefit here, which is what you're talking about, is the amount of this line multiplied by however many months or however many years you are actually holding onto the property. So you are getting an actual benefit that you need to calculate in this case of $77 per month over the course of 4 years. That needs to be accounted for. Okay. All right, guys, thank you very much. I've enjoyed having everyone here. I always do. I'm going to wish you the very best. Let's keep learning together. And thank you very much for being part of the forum. Please invite your friends. We're still looking to gain membership. Okay. My best.